They called it the end of tax havens. It wasn't. In January 2024, the Organization for Economic Cooperation and Development activated the biggest international tax reform in a century. 140 countries signed on. A 15% global minimum corporate tax, designed to end the race to the bottom. Bloomberg called it the end of tax havens. The Financial Times called it history's biggest tax overhaul. Ireland, Switzerland, Singapore, Luxembourg, and the United Arab Emirates all agreed to implement it. And yet, buried on page 127 of the OECD model rules, there is a provision called the Substance-Based Income Exclusion. It lets multinationals legally strip 8% of their tangible assets and 10% of their payroll out of taxable profit before the 15% floor kicks in. Apple's Irish arm can legally exclude roughly $2.4 billion. Pfizer's, roughly $1.2 billion. This video is about the trap door the OECD built into its own 15% tax, who is using it right now, and why the global effective corporate rate in 2026 may never actually reach 15%. The 15% tax has an official name. Pillar 2 of the OECD's Global Anti-Base Erosion Rules, known as GLOBE. It applies only to multinational enterprise groups with consolidated revenue above 750 million euros. That is roughly 8,000 companies worldwide, responsible for about 90% of global corporate profits. The mechanics have three moving parts. First, the Income Inclusion Rule, or IR, lets the parent company's home country tax any foreign subsidiary that pays less than 15%. Second, the Undertaxed Profits Rule, or UTPR, lets other countries in the group claim what the home country didn't. Third, the Qualified Domestic Minimum Top-Up Tax, or QDMTT, lets the low-tax country itself collect the top-up first, keeping the money at home. As of January 2026, 52 jurisdictions have live Pillar 2 legislation. Another 28 have passed it, but delayed start. The rules cover salaries, factories, intellectual property, everything a subsidiary earns. And the top-up math is not gentle. If your effective tax in Ireland is 9%, the system is designed to force another 6 points somewhere, so the group as a whole pays 15. Here is where the 15% becomes something less than 15%. Article 5.3 of the OECD model rules defines a substance-based income exclusion, usually shortened to SBIE. It is a deduction against the tax base, not against the tax rate, but the effect is the same. Before Pillar 2 calculates whether your subsidiary is under 15, the country gets to subtract 10% of its total payroll and 8% of the carrying value of its tangible assets. Factories, warehouses, machinery, company-owned office buildings. That subtraction comes off the profit number the 15% rate is applied to. Consider a simple example. A subsidiary in Ireland books 100 million euros of profit. It employs 400 people with a combined payroll of 40 million. It owns a 200 million euro manufacturing plant. Under SBIE, 10% of payroll is 4 million. 8% of tangible assets is 16 million. Combined deduction, 20 million. Pillar 2 only applies its 15% floor to the remaining 80 million. If the local tax already paid covers that 80 million adequately, no top-up is owed at all. The subsidiary's real effective rate on the full 100 million profit is far below 15, and it is completely legal. The SBIE was negotiated into the rules on purpose to protect what the OECD calls genuine economic substance. Over time it shrinks. Year 1, 10 and 8. By year 10, 5% payroll and 5% tangible. But right now, in 2026, the carve-out is near its maximum. The SBIE chose its winners the day it was written. Ireland is the biggest one. Apple, Intel, Pfizer, Johnson & Johnson, Microsoft, and Google between them employ more than 50,000 people in Ireland and own roughly $80 billion of tangible assets there. That combination produces a SBIE carve-out of approximately $11 billion every year. The same pattern repeats in Switzerland, where Roche, Novartis, Nestlé, and ABB together carve out around $9 billion through their research campuses and manufacturing sites. Singapore benefits from ASML, Dyson, TSMC, and Shopee, where real engineering payroll and fab-scale capital make the carve-out material. The United Arab Emirates, historically a zero-tax jurisdiction, introduced a 9% corporate tax in 2023 specifically so it could qualify as a real tax regime under Pillar 2, while still keeping effective rates low after SBIE. The losers are the jurisdictions that never had substance. The British Virgin Islands, the Cayman Islands, Bermuda, Jersey, and the Isle of Man companies there are typically holding entities with a single employee and no physical assets. SBIE gives them almost nothing. Pure IP holding companies, like the ones that use to park Google's search patents or Apple's design rights, get carve-outs measured in the low millions, not billions. This is why, since 2024, Amazon, Google, Meta, and Microsoft have been quietly moving substance, real engineers, and real servers into Ireland, Singapore, and Zurich instead of the Caribbean. The second loophole is smaller but stranger. Qualified domestic minimum top-up tax. If a low-tax country collects the Pillar 2 top-up itself, the home country of the parent company is blocked from collecting it. The money stays where the substance is. Switzerland's cantons held a constitutional referendum in June 2023. 78% voted yes, specifically so Bern could keep top-up revenue instead of surrendering it to the United States, Germany, or France. Singapore activated its QDMTT on January 1, 2025. Hong Kong followed in 2025. Bermuda, of all places, passed a 15% corporate income tax in December 2023, effective January 2025, designed to capture what the United States would otherwise have collected through the IR. The Bermuda tax only applies to M&E groups already covered by Pillar 2. Everyone else still pays zero. Ireland's QDMTT was legislated into the Finance Act 2023 and went live in January 2024. For multinationals, QDMTT combined with SBIE is the friendly outcome. They stay in the low-tax country, pay the top-up locally, and get the maximum SBIE deduction before the top-up is even calculated. The United States Treasury loses the revenue. The subsidiary's real effective rate still falls below 15%. And because QDMTT is classified as a qualified local tax, no further top-up is owed anywhere else. The low-tax country wins, the multinational wins, and the high-tax home country is locked out. When the OECD announced Pillar 2, the headline revenue estimate was $220 billion of new annual corporate tax globally. That number shrank before the ink dried. In October 2024, the OECD revised its estimate down to between $155 and $192 billion after accounting for SBIE, transitional safe harbors, and the realistic path of QDMTT adoption. An EY survey of 750 affected multinationals published in December 2024 found that 78% expected their group effective rate to land below 15% even after compliance, primarily because of substance carve-outs. A specific look at Apple's Irish subsidiary, based on 2023 filings, shows roughly $16 billion of payroll and $15 billion of tangible assets worldwide concentrated through Ireland. Apply 10% plus 8%, the SBIE carve-out is about $2.8 billion. Pfizer, similar math, roughly $1.2 billion. Roche in Switzerland, about $1.6 billion. Total SBIE carve-out across the top 20 Pillar 2 payers is estimated at $35 to $45 billion per year in deducted profits. That is not hidden. That is the regime operating exactly the way negotiators designed it. The effective global corporate rate on Pillar 2 covered entities in 2026 is projected at 12 to 13%, not 15%. Ireland's effective rate on qualifying M&Es is modeled at 10.9%. Switzerland, 11.2%. Singapore, 11.7%. The United Arab Emirates, 9 to 10%. These numbers are legal. They are projected by the OECD itself. Three things are likely between 2026 and 2030. First, The United States has still not legislated a UTPR-compatible rule. The Inflation Reduction Act's 15% corporate alternative minimum tax does not match Pillar 2 mechanics. That creates a gap. Other countries can, in principle, use their UTPR to claim top-up tax on U.S.-parented groups for undertaxed U.S. income. Several, including Japan and South Korea, have reserved the right. Expect a diplomatic fight. Second, the SBIE phase-down is real. Payroll carve-out drops from 10% to 9.8%, then 9.6%, stepping down annually until it lands at 5% in 2033. Tangible asset carve-out declines the same way from 8% to 5%. That narrows the loophole roughly 40% over a decade. Third, new substance strategies. Multinationals are moving engineering, manufacturing, and senior management payroll into jurisdictions that combine moderate headline tax with generous QDMTT and high SBIE. Dubai, Singapore, Zurich, and Dublin are the obvious winners. The Caribbean and Channel Islands are writing off most of their multinational business. And the OECD is already discussing what a Pillar 2 version 2.0 would look like. One early proposal tightens the tangible asset carve-out to only include assets generating direct economic returns, excluding real estate held for appreciation. Nothing is close to adoption. Pillar 2 is real, and it is the most ambitious international tax project since the 1920s. It genuinely closes the door on shell company havens with zero substance. But the 15% floor it advertises is not the rate most covered multinationals will actually pay. The substance-based income exclusion means any company with real payroll and real tangible assets can legally drive its effective Pillar 2 rate well below 15%. The qualified domestic minimum top-up tax means low-tax countries keep the revenue their substance attracts. Combined, the two mechanics redraw the map rather than erase it. Cayman, BVI, and Bermuda shells are over. Ireland, Switzerland, Singapore, Zurich, Dubai, and Dublin are bigger than ever. The effective global rate is drifting toward 12 to 13%. Nobody at the OECD is surprised. They negotiated it that way. So when somebody tells you the era of tax havens is dead, the accurate answer is that the old ones are. The new ones are in better weather, with bigger offices and an OECD-blessed deduction built into the law. If you want the fine print other tax channels skip, hit subscribe. Every week we decode one loophole, one jurisdiction, or one piece of legislation that actually moves money. Hit the bell so you catch the next one. See you in the next video.